It is now time for lesson 15, so we will go ahead and begin our lesson. As usual, I need to remind you to take a few moments to read the disclaimer. Alright, on our agenda for today, we are going to be talking about a powerful strategy to trade non-trending markets. So we will begin our discussion by looking at non-trending markets, and then we will build the chart that we will use for our scalping strategy, and then we are going to talk about the details of this retail trade strategy and why we call it the retail trade strategy. Alright, let's begin by talking about non-trending markets. First of all, bracketed or non-trending markets occur in every time frame in the market. In other words, you are going to find them taking place on a daily chart, on a weekly chart, on a half-hour chart, on a 5-minute chart, and on a 1-minute chart. Every time frame there will be periods where the market will get into these phases where it is not trending. In other words, there is no directional movement one way or the other, and prices seem to trade in a narrow range or within a bracket. The other important thing to mention about these non-trending markets is the fact that they actually represent the majority of activity in the market. Some estimates range at about 70% of the time the markets are in fact non-trending. Unfortunately, non-trending markets do not yield the type of profit levels that you're going to see in a directional market. You just simply don't have the range of movement. So you have to settle for far smaller profit targets. Now, when you trade non-trending markets, it is a different process than directional markets, and you are going to find that you are going to take far more entries, and there will be, of course, more exits, so there is more interaction with the market, and you require a higher level of skill in terms of execution and in terms of being able to analyze the market quickly. A scalping trade also requires constant attention to the market. You can't simply put a position and walk away to fix a cup of coffee or grab a sandwich. You have to be continually attentive to the trade. Consequently, the process of trading in these non-trending markets and using scalping strategies can be somewhat stressful. Hopefully, as we go through our strategy and as you practice and learn it, this will help remove some of the stress that's involved in the process of trading non-trending markets. Alright, our starting task will be to build the chart that we will use for our trading of this strategy. And so let's take a look at how we will build our scalping chart. Our canvas, if you will be the 5-minute footprint chart. And I don't like to use anything smaller than the 5 minutes simply to allow you adequate time to analyze, because you have to look at the market and there are a number of different variables that you have to keep your eye on, and if you start looking at smaller time frames, they become far too noisy, and then at the same time you don't have adequate time to do the analysis that you need. The 5-minute chart is still a very powerful chart, and you will see works rather well with the strategy that we're going to discuss. Now, this is the same exact footprint bar data as you have just seen on the footprint bar chart that preceded this image, except this one does not have the box around the numbers and simply has the candlesticks in the background, or the numbers are overlaid over a candlestick. this is simply just a visual preference. As you're probably aware by now, Market Delta has a number of different ways to display the data, and you can select the one that is most pleasing to you and that you find easy to use. The data is really the same. The visual representation is just about personal preference. All right, the first indicator we add to our canvas or to our chart is the Keltner. And as we've discussed in the past, we begin with a 2 standard deviation Keltner. So I have a lower Keltner at 2 standard deviation and an upper Keltner at 2 standard deviation. Here's my midline, which is my 20 simple moving average, and notice how flat that 20 simple moving average is, and immediately that is an indication that you are in a non-trending market. A flat 20 simple moving average is a clear indication of a non-trending market. Now notice what has been happening to the Keltner. It was narrow back here and it has started to widen. Now it isn't widening because we're in any kind of a trend. We're still non-trending, but we're getting a little bit more volatility in the market. If you notice, the move swings are starting to be a little bit broader, and the Keltner is responding accordingly. So we're just getting a little bit more volatility. Now we're not going to settle for just one Keltner. We're going to have more than one. The other Keltner I want you to put on the chart is a 1 standard deviation Keltner. So right here and right here we have the 1 standard deviation, and of course the midline is going to be the same for all the Keltners that we will add. We're also going to add the 3 standard deviation Keltner, so I will have a 3rd line up here and a 3rd line down here. And the reason is, if we're in a non-trending market and the range begins to expand, I want to be able to see how far out we are from the 20 simple moving average, and it gives me flexibility in looking at the price movement. So plan on the 3 different Keltners on your chart. Next, I'm going to add my 8 simple moving average, and it is this light green line that you see here on the chart. And don't forget that we also have another moving average, and the other one is the 20 simple moving average, and this is built in to our Keltner. It is the midline. Don't lose sight of the fact that this is my 20 simple moving average. So now I have 2 simple moving averages on my chart plus 3 Keltners. The other thing that I want to bring to your attention is, if you take a look here, when the 2 moving averages fold together like that, this is often an indication of a non-trending market as well. They're both flat, hovering right above and below one another. This is again a clear indication of a non-trending market. Alright, the next indicator I like to add on my canvas is the footprint bar statistics. And you see that it gives us a lot of valuable data about every one of the bars. So that should be at the bottom of your chart. The next thing we want to include, and this is a very important part of the strategy, is the volume POC. And it should appear on every single bar. And you will see that if you use a light color, it will allow you to see some of the numbers a little bit better. Plus, it makes it visible for you where it is on the bar. Alright, now that we have our indicators, each day we have to look at the profile and select from the profile the key reference lines for the day. Naturally, these will vary from day to day, but we've also studied and learned which ones we need to hone in on, and we want to pick the ones that are closest to where the price action is. So for this particular day that we're looking at, which happens to be February 18th of 2011, the first key reference line we're going to have is the prior day's high, because look at how close it is to where we are. So we're going to put the prior day's high up here. The next key reference line is, of course, the day's open, when we opened. And we also want to add the prior day's close. Notice how all three of these lines are very close to where our price action is. All right, now that we have our chart all put together, we are ready to take a look at the retail trade strategy. The reason we call it the retail trade is because in many ways you are working like a retailer. You're going to buy something and you're going to sell it quickly in the market, and you have to be able to mark it up so you can sell it at a profit. The price that you buy it at is going to be very critical, because if you buy it at an expensive price, you're not going to be able to resell it at a profit. And you are continually going to work as a retailer does. You have to be buying and selling quickly, and you have a markup, and it's a standard markup, and the markup you will see in the strategy is fairly consistent. All right, before we even begin, we want to break up our profile into our mini profiles. So we're creating a small profile for every half-hour increment, and here this is the first half hour of the day, and here we are going to begin by looking at the first candle of the day. This is some of the early morning activity, and we really are not going to look at that. We're going to look at the open, the first 5 minutes of the market open, which is really period A on this profile here, just the very first period in this mini profile. Since this is a half-hour profile of period A, we have each 5-minute increment creates a column for us, or a letter, and 6 of them comprise the entire profile. So let's go ahead and take a look at this very first 5-minute candle, and it's interesting. It's a big red candle. And of course, what we want to do, we've established that we are in a non-trending state right now. Look at that simple 20 moving average. And we want to ask ourselves, is there a trade opportunity here? Well, let's take a look and analyze and see if the strategy will help us. The first thing that we want to look at is the volume point of control. Well, where is it in this candle? See that cyan line? That's my volume point of control right here. All right, it is at the lower end of the candle. So the VPOC is at the low end of the range of this candle. Now, where is it relative to the prior candle? Well, it has dropped lower. All right, now let's take a look at the actual volume that traded at this volume point of control. 11,693 at the bid and 5,000 at the ask. So we have about twice the volume at the bid than we do at the ask. And obviously this is very bearish. Now let's take a look at the POC volume from our bar statistics, right at the total volume, 17,000 to 8,000. So that's almost a double the volume has taken place between the two prior bars. All these are very bearish indications from the volume point of control. All right, next we're going to look at the volume itself, the total volume. And we see that we had a significant increase over the prior bar. When the bar opened, the first 5-minute bar, the total volume for it was 57,000 to 21,000 on the prior bar. That is almost 3 times. That is a significant increase. And what did we see happen? A range extension to the downside and a drop in the volume POC. That's the next important thing we want to talk about, this range extension. Take a look. This was the low of this candle. Now we extended even lower by 3 TPOs, 3 ticks below. It is a minor extension lower, but nevertheless, with all these other factors that are somewhat bearish, it just adds to that bearish pressure. All right, now where is the price in the Keltner? right now the price is right at the center of the Keltner, and it's being pushed downwards. And remember, the mid-Keltner is the 20 simple moving average, as we have mentioned earlier. Alright, the last thing that we want to look at is where is the nearest support or resistance for price? Well, we are right at a support level. So this would often make me pause if I wanted to take a short. But the preponderance of the evidence and the pressure to the downside would actually encourage me to take a short, even though I do see that I have support at the prior day's close and the 20 simple moving average. So if in fact we are going to take a trade here, our trade would be a short trade, and a preponderance of the evidence supports such a trade. Now we need to look at the details of the strategy. Where should our entry be? And our strategy gives us very clear, concise, and precise points of entry, and they're very important rules that you should always follow. First, let's take a look at the location of the entry. Well, you want to enter, since this is a short trade, at the volume POC price or one tick lower. Now, why is that? Now we have to apply some of the market auction principles. When the market auctions back and forth, it is always going to rotate to volume points of control, because these are the key levels in the market as it's moving. So if price is going to move lower, at some point it's going to come back and test at the volume point of control. If I place my entry as a limit order and wait with the short there, there's a possibility that I will get into the trade, but there is a higher possibility if in fact I place my entry one tick lower, so that as the auction market comes back to test at the volume point of control, I am sure to be filled. However, if it comes right to the volume point of control and I'm waiting there, there is a possibility that I may be filled, but there's also a high probability that I will not be filled. So to increase the likelihood of my being able to get into the trade, I like to put it one tick lower. Alright, so that is the logic behind where I place my entry. Now let's take a look at when I enter the market. You want to wait either until the 5-minute bar closes, or place your trade in the last 30 seconds before the bar actually closes. And why is that? Well, very often right before the bar closes, you will see that the market makers will come in and throw some volume that will completely change the dynamics of that bar, and it will trap a lot of people in that bar, because certainly they'll push it in a direction opposite to what everyone was thinking. So you want to avoid that, and that's why you want to wait either until the bar closes, so you've confirmed that what you've seen is in fact the reality of the bar, or the last 30 seconds, because then there really isn't a whole lot of time for manipulation. When you paper trade and practice this strategy, try to use both and see which seems to work better for you. Alright, so now we've talked about the selection of the entry price and the timing of the entry. Now we want to talk about where to place our stop, and our stop is a very important element of this strategy. You usually will place your stop at the open or the high of a bar, the bar at which you made your decision to enter. In this case, since we are taking a short, we would like to put it either at the high or the open, and in this case, because I have a rather large bar, I feel comfortable and safe putting it right at the open. Now, my target consistently will be 3 ticks. So I have my 3-tick trade, I've placed my entry. Now let's move on to the next bar and see what actually happens in the market. Okay, just to review, location of all the different elements of the trade. Here's my target, here's my entry, and here's my stop. And here is the next candle. Take a look at that. 3 ticks. I entered up here, and 1, 2, 3, and 1 beyond. That's what I like to see, so it ensures that in fact I was filled and I am out. So I just made my first 3 ticks. Fairly simple if you approach the strategy in a systematic and an orderly manner. All right, do we take another short now since we were so successful with this trade and things worked out so well for us? Is it time for another short? Well, let's not be hasty. Let's take a look at where things are in the market. We continually have to analyze where we are. What happened from this bar to this bar? Let's take a look at our volume POC. Look at it. It dropped. Did it take a big drop? Well, 1, 2 ticks. Volume POC is towards the high of the new bar range. Take a look at the range of this bar and where the volume POC is relative to it. It's actually above the midpoint, so it's at the high of the range of the bar. This is a bullish sign, not a sign for a short trade. Volume has also dropped from 57,000 to 41,000. Now, if you ever get an increase in volume as you have a directional move, that is a clear indication of continuation in that direction. Whenever volume starts to drop, the opposite holds true. The likelihood of continuation decreases. All right, so obviously we did not have a good short at that point, and let's take a look at the next 5 minutes. We had no range extensions. If you look here, this bar did not drop any lower than the prior bar. It is an inside bar. The complete range of this bar is engulfed by the range of the prior bar. The volume POC is 1 tick lower than the prior bar, so we didn't have really a significant drop at all. And volume has dropped from 41,000 to about half, 21,000. And what did we just say about continuation? If we get increases in volume, there is a likelihood of continuation in the move. If we get decreases in volume, there really is a greater likelihood of no continuation. So obviously at this point, again, we would not consider a short entry. All right, now we get a new bar. And things are somewhat interesting at this bar. The first thing that I want to bring to your attention is take a look at the volume. The volume increases again, and it increases by about 1/3. And interestingly enough, the bar is an expanded bar. Its range now is higher than the one that precedes it, and also lower, but it's even higher than the one that preceded this one as well. So we get a really nice wide range bar relative to the two before it. Now we need to compare the expansion or the extension that occurred to the upside versus the extension that occurred to the bottom side. And we find that we got 2 TPO range extension up and only 1 to the downside. So definitely we are favoring a bullish sentiment here. Now let's take a look at the volume POC. It's at the same level as the prior bar. Notice where the cyan line is on both bars. The negative delta is minus 5.9, so it's not a very high percent. We get that nice increase in volume, about 1/3 higher. And price now has made it above the mid-Keltner. Take a look. The gray line here is our mid-Keltner, or once again, it is our 20 simple moving average, and price now has managed to pierce above it. All these are bullish lines, bullish sentiments, or bullish signs, if you will. Now, if you take a look at the price, if it manages to go above the mid-Keltner, it is going to head higher to test the first standard deviation. Based on this logic, I would be comfortable with a long entry. And so let's go ahead and place our long trade together. As usual, our rule is we will look for the VPOC on the bar, and we will place our order. Since this is a long order, we'll put our limit order one tick above the volume POC. And I will always integrate in my order the stop and the target. And I want the target in there quickly because the target usually will fill very quickly in the market. So now I've placed my long entry one tick above the volume POC, and I'm going to do this in the last 30 seconds prior to bar close or after the bar closes. I'm going to place my stop at the low of the bar, which is right here, and my target is at 3 ticks or the Keltner at 1 standard deviation. Now let's take a look at the next candle and see what happens in the market. Here we go. We get the next bar, and our target is in fact reached. Here was our entry, and 1, 2, 3, and 4. So it exceeded us by 1 tick. That's what I always like to see. Again, it ensures that I'm out and that I get filled. My target is reached, and I have another successful trade under my belt. All right. The key question now, of course, is with this success that we've just had, do we go back in? The market going higher now. You got to remember, we are in a non-trending market. Don't start thinking trends when you are in a non-trending market. Take a look at that 20 simple moving average to remind you, you are in a non-trending market. So do we go back in or not? Well, let's take a look at the particulars and the details of what is happening in our market. Volume starts to decrease to about half. It decreases from 33 to 16,932. And once again, what did we say about volume? If volume increases, the likelihood of continuity increases. If it decreases, that is the opposite. Now let's take a look at our range extension to the upside. Only 1 tick up. Even though the POC moved higher 3 ticks. So the volume point of control moved higher, yet it was not able to push the range any further up than just 1 tick. This tells me the buyers have really encountered increased selling here. It's a very important point, very important observation. Your volume POC is moving up, yet we're not able to push prices any more than 1 tick up with the range. So obviously I am really meeting some sellers here. Now let's take a look at the statistics of the volume point of control itself. 4,260 contracts traded at the bid and 3,995 at the ask. Very close numbers to one another. Neither one really dominated the other. It's just a small difference of about 260 contracts. Let's take a look at the actual wins and losses in terms of prices. If you take a look at the red levels here, 1, 2, 3, 4. So I have 4 wins for the seller and just 1 win for the buyer. So obviously the sellers are starting to show some clout here. Now what's interesting also is that prices are at the 1 standard deviation of the Keltner right here. So again, if we are in a non-trending market, this may in fact be a point where prices may turn around and start to move in the other direction. Well, let's take a look at the next bar. And the next bar is the 6th bar since the day opened. So it's 1, 2, 3, 4, 5, 6. So I have 6 5-minute periods. So remember, on the profile, that's the first half hour. All right, what is happening on this 6 volume or this 6 bar? I have a slight volume increase from 16932 to 1876. This is a very slight. Now, what's interesting on this bar here is that you will find that I don't have any range extensions, neither up nor down. Take a look. The range is pretty much the same as the one that preceded it. Now let's take a look at the volume point of control. 3,395 at bid, 4,619 at ask. Again, no significant margin favoring one side or the other. I mean, the ask was a little bit higher, but not significantly. It's not 2 or 3 times as much. So this is not going to push prices strongly in one direction or the other. Look at the TPOs. 3 wins for buyers and 2 wins for the seller. You can see here the seller in red, 2 wins, and in blue the buyer comes in with 3. So 3 to 2, again, not a very strong ratio. What I'm really seeing here is that the market is telling me there's no conviction yet. We're still very much uncertain, and we are continuing in this non-trending manner, and that perhaps the range has just tightened a little bit. So now you will see that prices are trading above the day's close, but below the day's open, above the prior day's close, but below today's open or the day's open. And you can see this is the prior day's close, and this is the day's open, and that's where we seem to be in this particular bracket. Now notice also, it's interesting, price is trading within 1 standard deviation of the Keltner. Take a look at that. Here's the midline, and here's the 1 standard deviation. So it's a fairly narrow, tight range. Well, let's move right along and see what happens on the next bar. Aha! The 7th bar. The volume POC jumps up. It moves up 3 ticks. And the volume at the POC is really high at the ask. It's about 3 times what it was at the bid. And I do see an increase in volume from 18 to 26, 18 to 26, and I see a range extension up 2 ticks. All right, so we've made it all the way up to the open. But I need to look to the left. Learn to look to the left. The LL function, we call it. Look left, look left. It's so important, and you will see why. What's been happening to the left of us at this open? I had resistance and I had resistance. So obviously I don't want to be taking any longs right into resistance in a non-trending market, especially since this test failed, and this test may also fail, but it doesn't bode well for it. I have major resistance at the open, and now since I have 6 different candles, 5-minute candles that have been completed, and I have a full mini profile to look at, I need to look at that developing profile for some additional clues. All right, here's my profile of the first 6 candles that we just looked at, and here's my initial balance, and here's my value area. Here's the low value area, this green line, and the high value area, and my point of control. And take a look at where I open now with this 7th candle. I open towards the high value area of this prior half hour. So this is a rather bullish sign. Now, I haven't really seen the rest of the profile, so imagine only seeing the A period there. I haven't broken the range to the upside or to the low side, so I'm really still trading within value, which tells me that we are in a 2-sided trade mode, or we're still very much range bound. And so I would not be thinking about any longs at this point heading into this powerful resistance level. Alright, so let's take a look at what happens when we get the next bar, bar number 8, or the 8th bar. Well, range extension lower. Very important to look at where the market is facilitating trade. Is it towards the upside or the low side? And we find this out by looking at range extensions, one of the ways that help us. So range extension lower, 1 tick, as you can see here. We have a lower high and a lower low from the prior bar. So here's my lower high and here's the lower low. My volume point of control drops 2 ticks lower. Take a look at this. It used to be here, now it's down here. The volume point of control, I get 3,411 at the bid to 1952 at the ask. And the volume decreases from 26 to 14,000. 3 seller wins to 1 buyer win. Volume point of control at the mid-range of this new bar, right here at the mid. And then we have support at the prior day's close. Take a look at this. Here's the support that we have. Once again, I'm trapped between a strong level of resistance up here and a level of support below. So I would stay out and not do anything. Let's take a look at what happens on the next bar. Well, the next bar is a red bar, and the volume POC actually drops, and the range extends lower 2 ticks, and the volume POC at the lower end is at the lower end of the range. Take a look here, it's down here, just 1 tick above the low. So all these are very bearish signs. Not only that, take a look at the volume POC, 4,622 at the bid, 3,590 at the ask. This is fairly weak domination. Again, it's just about 900 or so contracts greater than the ask. So it doesn't tell us much here. This one is a rather weak input in terms of who's in control. I have a slight increase in volume from 14,192 to 20,000, as you can see here. I also have 4 sell wins to 1 buy win, so obviously the sellers are dominating, and you can see it here. The 8 simple moving average is moving lower. Take a look at it here. It's coming down. And I have a flat 20 simple moving average. Remember, the flat 20 simple moving average is telling us that we are in a non-trending period. The fact that the 8 simple moving average moves a little bit lower really is somewhat insignificant, because there's not much of a slope and it could just turn right back around. I would say it's still folding around the 20. Now, I have some bearish signals here. The range is extending to the low side. The volume POC is at the low end of the range. There are a number of things here that would that might persuade me to take a short. However, I would only do that if I'm short-sighted and I've already forgotten what I have referred to as the LL rule. What was the LL rule again that we talked about in this lesson? Look to the left. Let's see what we find when we look to the left. Wow. I have a very determined buyer at this level. When prices dropped below this 1 standard deviation of the Keltner, they picked it up once, they picked it up twice, they picked it up 3 times. Not only that, this time when they did it, this was probably the most forceful volume increase that I have seen in the past half hour. So 33,810 here, 41,000 here, 21,000 here. That's quite a bit of volume. in terms of buyer support, and I'm coming right to this level. I would be crazy to short. Not a good short. My LL rule saved me. Look to the left. All the other signs were saying that it would make sense to short, except this powerful one here to the left. Now you see why I emphasize the look to the left rule. Now take a close look at the last strong buyer entries. They were all at this level. The strong buyer is sitting at -1 Keltner, and so I would not want to take a short here. Alright, now let's take a look at the 10th bar and see what happens. And in fact, what happened is prices did not extend any lower, so obviously the seller is still, the buyer is still here, is still present, and is still defending this line. And there is no strong seller conviction. So we really did not see any major volume here that would overcome what we saw earlier in terms of the buying pressure back here. 20,000 or so is not going to cut it. And then now with 14,000, we see that prices managed to engulf the prior candle's range completely. So obviously the buyers now are starting to take control. They've stepped back in and they are dominating the sellers in this candle. Equal range, you see how the range of this candle is pretty much equal to that one. And notice another important development. The volume POC has moved higher, and in this case it's towards the high of this new bar. And here is my ratio of ask to bid. And even though the numbers are not huge, it's still about double on the ask versus the bid. So this was in fact the expected move that we anticipated by looking to the left. All right, naturally, since we've seen this support here, this would be another good trade opportunity for a long, and we're going to follow our rules. We're going to enter at 1 tick above the volume POC right here. We're going to put a stop at the bar low right here, and our target is the usual 3 ticks. So let's take a look now with the lines where we are. We have our stop, we have our entry, and we have our target all highlighted on the chart. Now let's take a look and see how the market progresses. Well, what happens with the next candle is we go up only 2 ticks. Now we have not reached our target, and the question that we need to answer for ourselves is, do we stay in this trade, or should we start managing the trade to get out with a minimal loss? Well, let's take a look at what the market tells us. First of all, the VPOC has moved higher. Take a look here. The volume point of control went up from here to here. To here. So it has moved higher. The range extension that took place to the upside, and we have an increase in volume. And remember what we talked about, continuation? Whenever you get an increase in volume, there is a greater likelihood of continuation. And the direction that we want to continue in is up, and this is our target up here at the first standard deviation, or to get our 3 ticks. And let's see if we can in fact make it on the next candle. So we stay in the trade because the market is telling us it's still prudent to do so. Sure enough, the next candle makes it to our target. We reach the target and we are out of the trade. Not only that, as usual, as I like it, it exceeds my target by 1 tick, ensuring that I will get filled and I'm out of the market. And look at what I have now. I have another volume POC even higher, and my range even extends further up. Now with this success under my belt, am I ready for another trade? And do I want to take a short or do I want to take a long at this point? Well, let's look at it closely together and see what makes sense. First of all, we are at a level of resistance right up here, and it was established as a level of resistance back here. So should we take a short? Or we certainly do not want to take a long, because if you see what is happening here, the sellers are starting to come in and dominate, and we're also at a point of resistance. So the long does not make any sense, and the question is, should we consider a short? Well, let's take a look at what the arguments would be in favor of a short. There's lower volume, so we're not going to continue up. We have 4 sell wins to 2 buy wins, 1, 2, 3, 4, and only 2 buy wins here, so the sellers are dominating. The VPOC has more at the ask than at the bid, so this is actually favoring the buyer. And we have a higher volume POC, a range extension to the upside, 8 and 20 simple moving average rising, take a look at them, a higher high and a higher low on this bar. The information really does not give me a clear indication for a short, and I certainly, because of the resistance up above, would not be inclined to take a short. Remember, we're not in a trending market, we are in a non-trending market. So I would sit this one out and I would wait for a little bit more information. Let's see what happens when we go on to the next bar. Alright, here comes the next bar. And what we see is more selling, but no range extension down. The volume POC also drops, but we also do not see a range extension down. These two signs here are very bullish. Even though we're getting some selling, we're not getting any range extension down. What does that tell us? It tells us that every time the sellers throw something at the market, the buyers are right there to pick it up at the bid. They think it's a bargain. But take a look at what's happening here. Volume decreases again from 19,000 to 9,000. So activity level is really slowing down. Again, not a good time for a long or a short. Time to sit this one out. Let's go on to the next candle. And the next candle, or the next bar, here's what happens. We start to see more selling, but no range extension down. See, 1,715, but the range is not extending lower. The volume at the POC is high at the bid and low at the ask, but still no range extension. The VPOC between these two bars is still at the same level. So we haven't really seen a strong move down. Slight volume increase, but notice what's happening. The range is really getting narrower. But the signs that I'm starting to get are very bullish about the market. That even though I am encountering some selling, I'm not getting much of I'm not getting any range extension down. Folks, this is very bullish. The buyers are dominating. Even though you see these candles and you see lots of selling, the buyers are capturing everything that these guys have to sell. Alright, now we get a new candle, and as we had suspected, it shows the buyers moving prices even higher, and this time we get a range extension to the upside. So we decide, let's take a long entry and let's get in on some of this action. Well, let's place our entry as usual, one tick above the volume POC. So we'll place the entry right here. Our stop at the open, which is down here, and we'll shoot for our 3-tick target, which is up here at about 1 standard deviation. And let's take a look at how things develop in the market. All right, we get the next bar, and it has no range extension to the upside. Folks, whenever this happens, it is a bad sign. This is bad news. Things aren't working out the way that we've liked, and you should adjust your position immediately to get out. Immediately tighten the stop to break even. Get ready to exit the trade. Things did not work out. The volume POC is still at the same level, so I still have a chance to get out, but I'm not going to make any money on this trade. Break even is the ideal target. So you take a small loss and you get out of the trade. Now let's see what happens. There is more selling pressure, but what we have is we've encountered resistance at the prior day's high. Take a look at that. It has stymied the move up. Even though, take a look at this simple moving average and how the 8 simple moving average at how it's been going up. But nevertheless, this level of resistance is pushing back, and don't think that this will save you, because the 8 simple moving average could just as easily now go flat or start turning down. So that's why you don't want to take, you want to keep an eye on it, but you don't want to take your signals from it. You want to look at the actual hard numbers in the market. Now, again, we're starting to see narrow movement, narrow ranges, but more selling pressure. But I don't want to short, because if you notice, I do see that I'm starting to develop a bias to the upside. If you notice, we seem to be building higher lows and higher highs as we progress. So even though I'm encountering some resistance here, I definitely would not be taking any shorts. So we have some resistance at the day's high, and again, keep an eye on that simple moving average. All right, take a look at what happens now. I get a very big red candle, and that's quite a bit of selling, and not only that, I get an increase in volume, selling volume. My volume POC also drops, and I get that range extension to the downside that I love. So do I jump in and take a short? No. Why? My LL rule. Look to the left. What's happening at the left? Prior buyer support. Once, twice, 3 times, 4 times. Whenever price came to this point, they stepped up and bought it and took it higher. So when I see this, I do not take shorts. Let someone else take them, but I will not. So let's see, even though it had a lot of the signs that normally would make for a good short, except my LL rule told me, no, this is not a good point to be shorting. All right, let's take a look now at the big picture. We have resistance up here, and we have support down here. And we're trading in a very narrow range right here between the 20 moving average, or the mid-Keltner, and notice how now the 1 standard deviation is starting to widen. There's not my 1 standard deviation, and also I am sort of stymied by the prior day's high up here. All right, let's continue on and see what happens. Oops. All right. Now we will take a quick glance at our profile. We have enough candles developed that we now have about an hour and a half on the profile. and you can clearly see that we're developing an uptrend. Look at the value areas. What's been happening on the profile? The value areas have been moving higher and higher, ever so slightly, but yet higher. So value in the market is going up. I need to start changing my thinking about the market. And that's why taking a short would not be smart at all at this point here. If I keep my eye on the profile and I see what is happening to the left, I know that I should not be taking a short, but what I should be looking for is the next opportunity to go long. All right. And fortunately, it doesn't take long. The opportunity comes quickly. In the next candle, take a look at what happens. Even though we had this big red candle, the next candle manages to penetrate all the way up to above half of that big candle, and we don't get much of a range extension down at all. Just one tick, that's all we get. So it is time now for a long entry. Once again, one tick above the volume POC, and we put our stop at the bar low right here. And this time, because of the information that I managed to get from my profile, that in fact we are now starting to trend upwards, I'm going to get bold and I'm going to buy 2 lots. Now, different traders have different capabilities, and typically some traders will trade 1 lot, meaning just 1 contract. Some 1 lot will be 5 contracts, some it will be 10, and then if you double, then it's 20. If your 1 lot's 5, then of course double that is 10. The one thing I will caution you about is sometimes some individuals get a little bit carried away, and when they double up, they will put down 100 or 200 contracts just for the 3 ticks, trying to get a quick gain. But what they don't understand is that changes the dynamics in the market. Whenever you throw that many contracts down, you're going to have problems with fills. Also, the market makers will take note of you and may intentionally push things one way or the other to make sure that they relieve you of those contracts. So don't think that the rules apply at any number. I would certainly not ever exceed 20 contracts for this strategy to work effectively. And the smaller, the better. All right, so we now know where our entry is. Our first target, this time since we have 2 lots, we have 2 different targets. Our first target at 3 ticks, and the second target is 2 standard deviations of the Keltner. Let's proceed and see how things develop. Aha, didn't take long. We reach our target in the next candle. So we're out with 1 lot or 1 contract, and we're still in with the other contract. To help increase my comfort level, often I will move my stop to break even. So break even would be right here, and I would hope that it would not take me out. Let's see what happens as we continue on. My stop is still at break even, and fortunately as we continue on, even though prices don't go any higher, they certainly do not go any lower, and now I'm starting to see some support develop above the open. See that? We're starting to see some support develop above the open, which is a very good sign. So we're still in the trade, and now my 8 simple moving average is hovering above, ever so slightly above the open. Hasn't really started to slope up yet, but it's still a good sign. It hasn't sloped down. So I'm in the trade, and let's continue on and see what happens. Well, I get another candle. Again, we don't get a range extension, but I'm still in the trade, and I don't drop any lower, and my stop is still at break even. So let's continue on another 5 minutes and see what happens. Big volume steps in, and that is always wonderful when that happens. So we get a breakout. Now things really start to crank, and look at what volume does to price. 48,000 comes in, and wham, 1, 2, 3, 4, 5 tick extension. I hit my target of the first standard deviation, the second standard deviation. I'm out, and it exceeds it by one more. So my second target is reached, and I have 8 ticks out of that target. So I had 3 with the first one, 8 with the second one. That gives me a total of 11 ticks. Even with a single contract each, that's still not bad. The market is now trending up. Things have changed in the market. It is no longer a non-trending market, and I need to adjust accordingly. Notice just some subtle differences. Even the 20 moving average is starting to slope up. So it is no longer as flat as it was before, and we continue to make higher lows and higher highs in the market. We are starting to see the early stages of a trend, and naturally it is time for me to start trading using a directional strategy and not a non-trending strategy anymore. That's why it's very important to keep your eye on the profile as well as on the short time frame or the 5-minute chart that you're trading, and look at the different variables in the market. Again, to emphasize the key things that will help you succeed with this strategy, always keep an eye on the profile as it develops during the day, because this will give you some great insights as to how value is developing in the market. Make sure you always enter at the right price. Do not chase. You put your limit order in, you have your target in place and your stop in place. This is crucial to this strategy. When you practice, learn to do it properly. Follow the rules. If in fact the signs are telling you that things aren't working your way, begin to take the right steps to get out of the trade with a minimum loss. This strategy requires lots of practice because there are a number of different elements that you have to be looking at, and some of them are numbers, and you have to learn to look at these different numbers. And most important of all, I always want to remind you to learn to look to the left. Look at what was happening and happening recently. Hopefully, once you master this strategy, it will help you tremendously in non-trending markets and will allow you to capture some profits in those types of conditions.